Do you want to understand how to maximize your tax savings? If your answer is a resounding yes, then you're in the right place. Today, we're going to delve into the world of tax savings, a realm often mistaken for being convoluted and complex. However, with the right knowledge and strategies, it can be navigated smoothly and can potentially save you a significant amount of money. Why is tax planning important? Well, effective tax planning allows you to make the best use of the tax laws to reduce your tax liability. Various strategies can be employed, each designed to align with your financial goals and circumstances. The benefits of efficient tax strategies are manifold. They help you save money, plan for the future, and ensure you're making the most of your hard-earned income. In this video, we'll be discussing 10 key strategies that can help you maximize your tax savings. These include understanding deductions, contributing to retirement accounts, utilizing tax credits, and considering tax-efficient investments. We'll also explore the advantages of health savings accounts, the concept of tax loss harvesting, and the benefits of choosing tax-efficient funds. Furthermore, we'll delve into the intricacies of gifts, inheritance planning, and the use of flexible spending accounts. And last, but certainly not least, we'll stress the importance of staying informed about the ever-evolving tax laws and the potential benefits of consulting a tax professional for personalized advice. Remember, the aim is not to evade taxes, but to understand the tax laws and use them to your advantage. By employing these strategies, you can ensure you're not paying more in taxes than you need to. So, are you ready to dive into the world of tax savings? Are you eager to learn how to make the most of your income and potentially save a significant amount of money? If so, buckle up and prepare for a journey into the world of tax savings. Now let's dive into these strategies one by one. First, familiarize yourself with available tax deductions. Now, what does that mean? Well, tax deductions are essentially discounts on your taxable income. They're subtracted from your income before it's taxed, which means they can significantly reduce the amount of tax you owe. One common type of tax deduction is related to education. If you're in school, you might be able to deduct tuition, fees, and even interest on student loans. Homeownership also comes with its own set of deductions. Mortgage interest, property taxes, and sometimes even home office expenses can all be deducted from your taxable income. Charitable contributions are another popular deduction. If you've donated to a registered nonprofit organization, you might be able to deduct the amount of your donation. These are just a few examples of the many deductions available. So, delve into the deductions relevant to your unique situation. Knowledge of these deductions can significantly reduce your taxable income. Maximizing contributions to retirement accounts is a win-win strategy. Why, you ask? Well, let's delve into the dual benefits of this approach. Firstly, when you contribute to retirement accounts like 401(k)s and individual retirement accounts or IRAs, you're essentially preparing for a financially secure future. That's an investment in your peace of mind. But here's where it gets interesting. These contributions can also reduce your taxable income, and who doesn't love a lower tax bill? It works like this. The money you put into these retirement accounts is pre-tax, meaning it's deducted from your income before taxes are calculated. So, if you're earning $50,000 a year and contribute $5,000 to your retirement account, your taxable income drops to $45,000. So, you're not just saving money for your golden years, you're also actively shrinking your current tax liability. Remember, saving for retirement today can mean tax savings tomorrow. Tax credits are a direct way to reduce your tax liability. This is like having a discount coupon for your tax bill. Let's talk about some of the common ones. The child tax credit, for instance, is a beneficial provision for taxpayers with dependent children. It can directly reduce your tax bill by a substantial amount per qualifying child. Then there's the Earned Income Tax Credit, designed to benefit working people with low to moderate income. It's a refundable credit, meaning it can reduce your tax liability below zero, and you could receive a refund. Education-related credits, like the American Opportunity Credit and the Lifetime Learning Credit, can help offset the costs of education. This could be particularly useful for students or parents of students paying for college expenses. Each credit has specific eligibility requirements, so it's important to understand these before claiming. However, when used correctly, claiming these credits can significantly reduce your tax bill. Investments and health savings can also offer tax benefits. We're talking about strategies that include tax-efficient investments and health savings accounts, or HSAs. Let's delve a bit deeper. Firstly, tax-efficient investments. Consider strategies like holding on to your investments for the long term. Why? because it allows you to benefit from lower capital gains tax rates. It's a simple approach, really. Buy, hold, and let your investments grow while keeping your tax bill at bay. Now let's talk about health savings accounts, or HSAs. If you're eligible, contributing to an HSA can be a smart move. These contributions are tax deductible, which means they reduce your taxable income. And there's more. Withdrawals for qualified medical expenses are tax-free. That's right, tax-free. So you're not only saving for your healthcare needs, but also saving on taxes. So remember, invest wisely and save on healthcare expenses to enjoy these tax benefits. There's more to investments than just buying and selling. Navigating the world of taxes can seem like a daunting task. However, strategic investment decisions can be a game changer. Enter tax loss harvesting, a concept that's as intriguing as it sounds. It's all about offsetting capital gains by strategically selling investments at a loss. Sounds counterintuitive, doesn't it? But here's the catch. By doing so, you can actually help minimize your overall tax liability. It's like making lemonade out of the lemons life throws at you, financially speaking. Now let's talk about tax-efficient funds. These are your mutual funds, or ETFs, that are designed to limit your tax burden. They do this by having lower distributions of capital gains. So, you're not just investing to grow your wealth, but also doing it in a way that keeps Uncle Sam off your back as much as possible. Strategic investment decisions can help minimize your overall tax liability. Even gifts and inheritances can have tax implications. A surprising fact, isn't it? It's essential to be mindful of the gift and estate tax limits. You see, gifts below a certain annual exclusion limit, which is $15,000 as of 2024, are not subject to gift tax. Anything above this limit might be taxable. When it comes to inheritances, the estate tax kicks in at a high threshold, currently over $11 million. It's wise to strategically plan gifts and inheritances to minimize these tax implications. Now let's pivot to flexible spending accounts, or FSAs. These special accounts allow you to contribute pre-tax dollars for healthcare or dependent care expenses. This means that money goes into these accounts before it's taxed, effectively reducing your taxable income. So if you're eligible, FSAs can be a great tool to save on taxes. Plan your gifts, inheritances, and healthcare expenses strategically to save on taxes. Remember, every penny saved is a penny earned. Finally, stay informed. Just like the seasons, tax laws change. They ebb and flow with the shifting political climate, economic trends, and societal needs. It's crucial to keep a finger on the pulse of these changes, as they could significantly impact your financial situation. One year you might find that your favorite deduction has disappeared, replaced by a new one you hadn't even considered. Or perhaps the tax brackets have shifted, nudging you into a higher or lower category. Staying informed isn't just about keeping up with the news, it's about understanding how each change can affect you personally. Now we understand that tax laws can be complex, and sometimes feel like they're written in a language all of their own. That's where tax professionals come in. These experts dedicate their careers to understanding the ins and outs of the tax code, and they can provide the personalized advice you need to navigate it confidently. Think of a tax professional as your personal guide through the wilderness of tax law. They can help you understand the implications of new laws, identify tax-saving opportunities you might have missed, and even help you plan for the future. And remember, tax planning isn't a once-a-year activity, it's an ongoing process. Just like you wouldn't plant a garden and then ignore it for the rest of the year, you shouldn't file your taxes and then forget about them until next year. Regular check-ins with your tax professional can help ensure you're on track and taking advantage of all possible savings. So, whether it's reading up on the latest tax news, scheduling regular meetings with your tax professional, or simply taking a few minutes each month to review your financial situation, staying informed is critical. Because when it comes to taxes, knowledge truly is power. Remember, the key to maximizing tax savings is staying informed and making smart, strategic decisions.